Morning to our wonderful audience and welcome back to Boutiques on Wednesdays. South African bonds are one of those asset classes that received a lot of attention over the past 18 months or 12 months because of super attractive yields. And if you think that we're in the top of an interest rate cycle, it becomes even more attractive. In order for us to unpack subjects like bonds, BCI team decided to invite some of the top TFMs in the country to moderate sessions like this in the form of a panel discussion. And here to introduce our panel this morning and to moderate the session is Chief Investment Officer from Boutique Investment Partners, Tevonga Shivize. And maybe some background on BIP. They're one of the top asset consultants in the country, or better known as a DFM, as the industry are all aware of. With just over 65 billion of assets under advice and management. Some of their team members have been working together for more than 20 years, and they certainly offer a wealth of experience when it comes to asset allocation, manager selection, and portfolio construction. Tevonga, thank you so much for joining us this morning. I know it's crunch time for you. You've been up early hours this morning as well as you enter into your client review meetings or portfolio review meetings. So thank you so much for your time. We really appreciate it. And looking forward to your panel and introducing your panel and the discussion we're going to have on bonds this morning.
Good morning, Eugene. Thank you so much for the lovely introduction. Good morning, everyone who's joined us today. I want to introduce our panel. So I think first up, I have Nolan from Anchor Capital. And then I've got Rowan from Argon Asset Managers. I have Jonathan Mason from Visio, and then finally I've got Philip Bradford from Portfolio Metrics. Welcome to the panel. Great. So both managers have great quantitative and qualitative profiles, and also on our buy list. So I think I'm looking forward to hearing what we're going to discuss with them much later today. I'm going to start off, I think, with more of an asset allocation discussion. So one of the best, I think, things about the bond market is outside, I think, just providing yields and all the other benefits that can in your portfolio. Often it is used to derive risk management signals. And some of the most familiar risk management signals would be the stock to bond market ratio. It would be things like the equity risk premium versus the bond risk premium to establish if equities, despite being cheaper, offering enough upside for the risks we face. They also give a sense of asset allocation choices between equity and property through the property risk premium, and often sometimes also help to discern between a bond bullish market environment and an equity bullish market environment using the yield curve. So far, if you look at all of those different risk management signals derived from the bond market, they all seem to be suggesting and indicating an environment that is very bullish for bond market. So starting off with Jonathan, what is your take, I think, on all of these risk management signals? What is your current interpretation? Does this apply to the South African bond market as well, especially if these signals are mostly used in the context of the global bond market? And what other considerations should we be thinking about from an asset allocation perspective as we respond to these risk management signals coming out of the bond market?
Thanks, Tevonga. I think the answer should take a slightly broader look at the global environment, and I'd focus particularly on the shape of the US yield curve, which you mentioned, which is probably the single most reliable. Most reliable doesn't mean that it's always reliable, but most reliable indicator of what the economic outlook is likely to unfold. And that's clearly showing that there is I would say, economic slowdown, certainly, and I think that's pretty broad consensus. The question is whether we A, get a recession, and B, if we do get one, how deep it is. Our base case is that the inversion of the yield curve suggests that there will be a recession, and it will probably be a relatively mild one. And by mild, I mean will not be accompanied by a financial market meltdown like we saw in 2008, to a certain extent 2020. Now, of course, there's a big question mark around that because, just over the last month, we really saw significant wobbles in US banks, and that usually something that we don't anticipate. And it's kind of a bit of a surprise. So from a global perspective, US Treasuries to us suggest that with a mild US recession, you can't, and at the same time, inflation still remains relatively sticky. You can't expect the Fed to come to the rescue if there's no financial crisis, which we don't think will happen. So we have a mild recession, which is positive for bonds, but it's not going to mean that bonds go back to kind of levels that we saw in 2021, 22. So remain relatively elevated. So that's the global backdrop, and that's obviously the base rate for global bonds. Bring it home to South Africa, like you mentioned, or Jean mentioned, bond yields are particularly high. And if you look at them on an inflation-adjusted basis, they're very attractive. And just kind of just a point to make that from an asset allocation perspective, our preference in our balance fund is for bonds and cash. So we think those asset classes, the yield that we're getting is sufficient to justify on a risk-adjusted basis as well to have that as your main asset or your largest overweight. So South African bonds are offering decent value given the inflation outlook, which is kind of moderating. I think again remaining sticky, but they're not cheap. And why I say that they're not cheap is because the problem that we have in South Africa is less of an inflation problem, which is the global problem. We have more of a fiscal problem. And therefore, and that we're not seeing really a strong resolution anytime soon. So in a nutshell, bond yields are offering fair risk compensation given the deteriorating fiscal outlook. They're not cheap, and to become cheap, what we need to see is we need to see significant government reforms and consistent and kind of viable strategy to ensure that the debt to GDP stabilizes, which we as a house currently not seeing happening. So value, yes, good risk adjusted, and it's basically a function of what we see from other asset classes, which equities are keeping very expensive. So bonds are certainly attractive, but let's not get carried away in my mind at this stage that they're cheap. They are good value and should be in the portfolio. And I'll leave it at that just for time's sake.
Thank you, Jonathan. I think we'll maybe extend the question to Philip and also to check if there is a scenario where we could compare from an asset allocation perspective local bonds to global equities as well, but still I think a general take on like the benefit of bonds as offering good risk compensation despite not being cheap.
Yeah, thanks, Tavonga. And it's an interesting question you raise because, asset allocation is not as simple as choosing individual asset classes and then putting them together. I often say asset allocation is a bit like putting together a Rubik's Cube. You might fix one side and mess up the other. So it's very important to understand where South African bonds fit and global bonds fit within your asset allocation. And if you think of it back to asset allocation kind of 101, is you trying to take the cash risk-free rate as your starting point, and then you're trying to outperform that. And historically, what you've had is that bonds have only given you a little bit of a risk premium, in other words, a little bit of a higher return over cash, and whether this is global and local. But if you're trying to optimize out of rands, when you've got bonds giving you the yields that they are at the moment, which are much higher, really, to be honest, than we've almost ever seen in terms of the offering. If you take the longer dated bonds, nearly 12% at the moment. We've never really had times in South African history, other than maybe like 1998, when longer dated bond yields were this kind of high. So you've got this big risk premium, in other words, excess return that you're getting from bonds that we didn't get historically. A lot of us grew up with a bond yield curve that was inverted. But back to the point on where do bonds fit in with global, South African bonds tend to be a risk on asset class. So where US Treasuries tend to do well when the global economy goes into a bad space, they're like a safe haven. SA bonds tend to do well when the world is in a better place. But the next step you've got to look at is understand, well, what's in the price. And yes, we can make arguments around risk that's prevalent in the SA bond market, but the yield curve is so steep at the moment, where the yield curve internationally is inverted, and in other words, factoring in inflation coming down over a period of time and growth weakening. Our yield curve, which should be impacted by exactly the same things, is still very, very steep. So in other words, from cash right out to the longer dated bonds, you're getting a very high excess return for that. So I think in the context of a South African investor that's trying to generate the best asset allocation return possible, bonds are still sticking out, their heads sticking out as probably the most attractive relative to history and relative to the other asset classes are out there. And I think in an environment where you start to see global risk settle down a little bit, SA bonds are priced to do very, very well. But then again, in an environment where if things continue pretty much as badly as they are globally at the moment, or things get a little bit worse, the yields are high enough to compensate you for that additional risk. So I think SA bonds in a global global asset allocation, in other words, trying to generate the best rand return possible with a global asset allocation, SA bonds will do well. And then your offshore equities and your offshore assets tend to provide you with the returns when SA bonds do badly. In other words, when SA bonds tend to do badly, in other words, risk is off a bit. And when I say badly, they're still probably going to give you positive returns. But in that environment, the rand normally weakens quite significantly, which then provides you with that buffer. In other words, compensates you for the risk you're taking in SA bonds. So in our asset allocation, we actually tend to trade off SA bonds against global equities. And when we did our big movement out of SA equities into global equities last year, we actually upweighted SA bonds at the same time we upweighted global equities.
Awesome. Thank you. Thank you so much, Philip. I think we'll move on to the next question, where in a bond bullish environment, the next key risk for many multi-asset portfolios is an extremely elevated rand in terms of being trading at cheap levels. On the one hand, one can argue that the rand is trading for at such levels to reflect the deteriorating fundamentals in South Africa. But on the other is always the possibility that we have a very strong and unexpected appreciation of the rand, like we saw in 2016, therefore injecting a lot of currency losses on the average balance fund in South Africa. So I think my question, for the next two panelists being Ruan and Nalan in that order, is how could we use bonds to offset the elevated currency risk? Is maximizing duration risk one of the easier ways? So we've definitely solved the asset allocation decision where on a risk compensation bonds are coming out favorably. Could we also use their higher duration link with the potential rand recovery to then manage currency risks as well? So I'll start off with Ruan and then we'll move on to Nalan on the same question.
Thanks, Abonga. I think we can start by just looking at that 2016 situation again a little bit more carefully. I think if you recall, 2015 December was when the country went through Nenegate, and the rand had blown out, bond yields had completely blown out during that period. I think the rand continued to blow out into early January, and that just set you up for the recovery through 2016 that we saw. Typically when the rand has these huge blowouts, you do have significant mean reversion thereafter. And similarly with bonds, a high starting yield in a bond increases your expected return over the forward-looking period. So we're slightly different at this juncture relative to where we were in 2016. The rand is certainly trading at elevated and cheap levels, but we haven't had the blowout just yet. An additional factor that's different this time is we've got prudential limits that have changed. And if you think about the rand as sort of the release valve in this economy, in the past where you might have had a sort of a slow leak in your tire, right now, because of the increase in prudential limits, the rand can extend its losses significantly before any recovery is driven by forced selling of dollar rand positions by local asset managers who are breaching their prudential limits. So that's just the comparison between where we are right now and 2016. So the rand hasn't blown out yet and can continue to sell off. And then to talk about your comment about or observation about using duration as a hedge for rand strength or rand appreciation rather, that's indeed correct. It's quite clear. I think if you look at the exchange rate as a macroeconomic factor driving asset price formation, that's evident in historical data. What we like to do is we like to segment your macro factors into percentiles. So right now the rand is trading quite cheap, top 25th percentile, in fact, even higher. And then we look back at how does the bond market perform if the rand has to rally from these levels. And indeed, there's a statistically significant relationship between 3-month forward returns in the all bond index and the rand appreciating from these levels on more than 2%. So your unconditional 3-month return on the all bond index is around 2.2%. But if you have to condition or filter all bond index time series for situations where the rand is weak and then strengthens by more than 2%, your average return goes up from 2.2 to something like 3.75. And also the distribution is way to the right of what your unconditional distribution is. So typically, or the worst loss you can see over 3-month periods about 8.7% on the OB. The worst loss when the rand is rallying is a little bit less. It's about 5%. So there is a statistically significant relationship there, and I think duration does definitely assist if the rand strengthens on you against your view.
All right, thank you so much. I think I'll move on to Nolan just to get additional input from that. And something that immediately comes to my mind, Nolan, is when you look at the bond yield curve, I think from year 12 all the way to 30, it's fairly flat. Well, not 100% flat, but fairly flat. And at that level, you're sort of getting an average yield, let's say, of 11.5, 11.25, give and take. And then you're also pretty much getting now, I think, a yield of about 10% from the average South African multi-asset income fund. The key difference, obviously, between a multi-asset income fund and a bond fund is most of these multi-asset income funds typically have duration of 2 years, 2.5 years or lower, whereas with a bond, you've got higher duration risk. So on the one hand, you could argue that given that the yields are not so different, there is no need for duration risk. But if we want, as soon as you bring in the currency risk, I think, and the comments that have been made by Rowan, you start to realize that without currency risk considerations, maybe there's no need to take duration risk. But with currency risk considerations, in a balanced fund that is already bullish on bonds, because of the earlier signals we spoke of, you may realize that that might be one of the only asset classes to help. What's your take, I think, on all of those things that I've just highlighted, as well as any other considerations that we're sort of missing out on?
Thanks, Tavonga. That is one heck of a complicated question. I feel like I've just caught a Rubik's Cube and been asked to unravel it in a couple of seconds. So let's give it a bash.
Great, thank you.
What is our take? Let's go back to Nenegate to start there. What really happened is we had, Nene was out, weekend minister, Des was in, and the market had a heart attack because it was pretty clear Des was there to steal national treasury. Risk premium shot through the roof. The rand weakened dramatically with a massive increase in risk premiums. Bonds did the same sort of thing. And then 2016, Des didn't survive more than a weekend. Praveen came in and he was kind of the best of a bad bunch, and the risk premium sort of mean reverted pretty quickly. But the key point is that the item that sparked the risk event, being Des, was in, and then the risk event disappeared. Roll on to 2023. What is the risk event? The risk event is basically SA government in the form of Eskom. We can't power our economy. SA government in the form of our choice of friends. We didn't get invited to the G7 for the first time in forever. Why? Because we really want to, increase trade ties with maybe countries that are, shall we say, a little bit more despot driven. And these are the key things that are driving us. No economic growth. So if I look at our models, what are our models saying? It's saying that the rand is about 10% weaker than it would have been outside of current issues. So instead of 1830, we'd be at 1650 without Eskom. Our bonds are about 0.5% weaker than they would be. So instead of the 11.5 you're talking about, it's about 11. So that's kind of, whoops, I just poured coffee on my desk. That's kind of the risk premium we're talking about. How does that mean revert? Well, Eskom sort of magically fixes itself. Our policies change a bit. We go and hug it out with people we actually trade with rather than people who, invade other countries. And, at that point in time, we sort of move into the good basket, and that risk premium that's been created disappears. In those sorts of scenarios, a positive SA scenario, 100%, you want to own bonds, and you're going to see a screamingly strong rand, and and you need something to counter that. And I think that makes a lot of sense. In the alternate scenario, which says that actually this doesn't get fixed particularly quickly, what happens is that government inefficiency manifests as inflation. We actually saw yesterday the Reserve Bank's going to tinker with its QPM model because it hasn't quite figured out how load shedding creates inflation. That's probably because there aren't really good examples elsewhere you can look at. So in that sort of a scenario, what happens is that as this inflation comes through, the rest of the world's in a deflationary environment. South Africa is not. So our short-term rates kind of stick out more and more. And if anything, actually, we see interest rate hikes continue a little bit longer, and we sort of disconnect from the rest of the globe that's an improving environment. In that kind of environment, SA short-term rates are great. Carry traders across the globe look at our currency and go, you've got to get some of this. So you end up with a strengthening currency, but higher and higher interest rates to sustain it. Kind of what happened in Ghana, actually, about a decade before they went south. And, in this environment, actually, that inverse correlation that you're looking for just isn't going to work. So I think you need to understand the dynamics of what's driving the market when you're looking, to take this exposure. By and large, we think it does work. We think, that this inverse correlation will continue. But there are definitely scenarios you've got to be aware of, and therefore you kind of got to, have your hands on the steering wheel when you take this position, let's put it that way.
Okay, great. So is it then a fair comment to say for multi-asset funds that already have much lower offshore exposure, then the argument of it's not worthwhile taking duration risk on bonds might work, but where that is too low for crisis periods, they might just need I think some duration kick from bonds.
I do think multi-asset funds that need a minimum amount of duration. Make no mistake, we released as allocation yesterday. We are overweight domestic bonds for multi-asset funds. We think on a risk-adjusted basis, it makes a lot of sense. It makes sense to hold them as duration assets. Would I hold them as a currency hedge? Yeah, probably, but you just want to be a little bit cautious on that.
All right, awesome. Thank you so much. Nolan, I'll probably just stick with, if you don't mind. How do you, the South Africa geopolitical risk premium, if we use the Bloomberg measure, is very elevated. The geopolitical risk premium on the global side is very elevated. Does that compromise the risk compensation advantage that we all seem to agree that South African bonds are offering over many other local and global asset classes? And should that worsen, how would a typical bond manager navigate through that scenario?
So South African bonds are attractive. We are increasing our weighting towards South African bonds because of the geopolitical risk. I think the market, has priced in a lot already. Bonds are screening as fair on our models, by the way, not screening as cheap. I agree with Jonathan. But, it is exactly this additional risk premium that means we can earn 11.5% on a bond that 3 years ago was offering 9%, maybe 4 years ago, before COVID, was offering 9%. So there's definitely an attractiveness to bonds because of this. As this plays out, though, what concerns us most is, I think Jonathan was saying, we're not seeing the Fed get to its 2% target. I'd agree with that. And one of the reasons is geopolitical tensions. The last decade, what was really happening is Chinese were taking American technology, using cheap labor, producing goods, and selling them to America. This was deflationary for the globe because you had cheap labor. I guess if you're stealing a cheap technology, which results in a deflationary environment for goods. That sort of drive of deflation seems to at least have stopped, if not reversed slightly. So you end up with a higher inflation environment, and that means rates are higher for longer. I think that means that bonds are by and large actually more of a carry trade. I think there are some capital gains to be had. We're getting to the end of the hiking cycle. Clearly, inflation is coming down. Issues, it's not coming down far enough, which means that interest rates are probably going to stay a bit higher. it means that bonds are a very attractive sort of carry investment, because if I'm earning 11.5% yield, if I don't get capital gains, it's okay, I'm actually very happy with my 11.5% yield. And from that perspective, we think that's how the sort of global dynamics play out. So, what they're really going to do for bond managers is just keep yields higher for longer, and they're going to keep bonds quite attractive. If I'm wrong and all the global sort of frictions disappear, then I've got a whopping capital gain on bonds anyway. So you're kind of in the best of both worlds, and that's how we're seeing it.
Okay, great. So that would not change anything. If anything, it adds to the appeal from what you're saying.
As long as it doesn't get worse. If it gets worse, it goes, the 11.5%, who's to say it doesn't go to 13. But there's a heck of a lot in the price right now. And, I think the risks are in your favor if you own the bonds.
Great. Jonathan, just to check, is there anything, a different perspective you would add if you have to? Otherwise, like any other comments around the geopolitical risk potentially compromising South African bonds' favorable advantage currently from a risk compensation perspective?
Yeah, I think the points kind of been made, but clearly geopolitical risk on two levels is critical. One is if we do have flare-ups anywhere in the world, they generally mean that there's a slightly risk-off environment, which is not positive for any of our South African assets. We are a capital-hungry country. We don't have enough savings. We rely on global flows, and we can see that they've been a problem for a while. That's probably exactly like what I'm saying. And that's led to kind of risk premiums rising to fair levels, but for good reason. So that's the global. The second link to that also is the choice that South Africa is making on who to participate, which side to be on, where the capital flows could be coming from. So that's the kind of the outright geopolitical risk. There's also something that is worth mentioning is the risk of a policy error in the major central banks. I don't think it's particularly elevated right now. But certainly we've seen the reaction, the monetary policy reaction that we've seen over the last 18 months is a function of you could argue, some policy error in 2020 where there was just too much stimulus. It was correct to stimulate, really, and if you listen to Janet Yellen, who very eloquently explains why and how correct it was to do it. The levels and the extent of the question. So maybe, the pendulum swung too far, and now it will require and might force a policy error where interest rates remain or rise too far, and basically the Fed has to decide between global growth, also US growth and US inflation, and is on the side of US inflation and ends up pushing us into a deeper recession as we're expecting it clearly, as all the panelists have explained, the global environment in which South African bonds suffer. That is the outright risk part. The base case is for a much more benign and actually supportive overall environment for South African bonds.
All right, no, thank you so much. I think this probably brings us to our last question, which is just around inflation-linked bonds in the context of the discussion we've had. So if I look at BIP's strategic asset allocation for a low equity fund or a low equity multi-asset fund with a target of CPI plus 3, the strategic weight we have to ILVs is about 10%. For a medium equity fund, that weight is about 7%. And then for a balanced fund targeting CPI plus 5, you've got a strategic weight of about 5%. The current average yield on inflation linkers is 4%. Should we have any capital gains of not more than 2%, then you get a scenario where easily you can meet your real return target for a CPI plus 3, 4, and 5 from inflation-linked bonds. Now, I think the question really then becomes, to the extent that bonds are already offering a superior advantage to other growth assets, is there a possibility where some of the proceeds of reducing those asset classes could come into inflation-linked bonds, especially if then one also might then make an additional argument, say they might offer higher duration risk than nominal bonds. So if you need duration risk for currency management, then some of it can be executed through ILBs. And then maybe another advantage being, should we have stick inflation, then you might just need that inflation protection. So essentially just trying to get a sense, I think from Philip as well as Ruan, like how critical are inflation-linked bonds as a potential overweight asset class in this environment for all the asset allocation arguments mentioned. And then obviously the other scenario where even with those strategic asset allocation weights, there might be reasons why they're not worth holding. Yeah, so we'll start off with you, Philip.
Yeah, so Tavanga, I actually, and in our asset allocation model, we don't see inflation linkers as a separate asset class. It's a sub-asset class within fixed income, and actually, I would see it as quite a smaller subset. And I think that the challenge we've got is that inflation-linked bonds, in theory, sound great. They sound like this great asset class that's going to give you inflation plus a return over time. But we've seen that hasn't played out because inflation linkers, you can look them over the last 5, 6, 7 years. They've significantly underperformed fixed rate bonds. Now, there's a couple of things there. First of all, which inflation linked bonds are you in? It's the same within our fixed rate bonds. You can't just say I'm in bonds. Well, are you in the short dated bonds, the longer dated bonds? They're all priced at different levels. And I think the problem we've got in South Africa is that inflation-linked bonds tend to be structurally overvalued because there's a very strong demand for inflation-linked bonds by your life companies, your insurers, your big pension funds that are running some sort of an inflation asset liability type strategy. So they tend to be overvalued in my mind relative to fixed rate bonds almost all the time. Okay, so we've got this crazy situation where at the time when you would think inflation-linked bonds are going to do really well, fixed rate bonds are generally priced better. And then secondly, they don't actually perform like you think they would. So if you look over the last 12 months where we've had the biggest inflation shock in many years, the inflation-linked bonds that should have given you the best return have actually have given you negative returns. Global is actually the interesting example. Global inflation-linked bonds in the middle of last year were down nearly 30% in some spots and others 15 to 25% in dollars. Okay, so the asset class that was supposed to do the best when inflation goes up, because you bought it at the wrong price, did badly. So you always need to be looking in your asset allocation and saying, well, if cash or credit or fixed rate bonds are compensating me more than I'm expecting from inflation, then you should be moving into those as an asset class. And be cautious of inflation linkers because they actually don't behave how you think they would. They don't just give you inflation plus a yield. That's not how they work. So I think it's very important to understand how inflation linked bonds work and how they're going to fit into the asset allocation. So I actually don't believe they should be a separate asset class within your asset allocation simply because they don't behave how you would expect to. And again, I've just, go look at the last 5, 6, 7 years. They've done less than half the return of bonds in an environment that was bad for bonds. So fixed rate bonds, when they've already priced in more than what you're expecting from inflation, I would far rather use those in the asset allocation. And similar right now, even credit type bonds, variable rate bonds. So I think if you're going to look at how do you protect against inflation in the South African context, the one area in South Africa that is quite different to global is our credit market, where the credit and bank type variable rate bonds are not fixed rate bonds. So they tend to do just fine when interest rates go up, because that's what you're worried about. You're worried about when inflation goes up, you're worried about interest rates going up, and you're worried about bonds, fixed rate bonds getting hurt by that. In the last 12 months, actually, fixed rate bonds have done okay. They haven't done that well in a bad environment. But variable rate bonds now, in other words, money market instruments and credit bonds and bank bonds have gone up. The yields have gone up with interest rates. So those have actually provided you with capital protection in terms of the capital hasn't fallen. And they're giving you that additional yield that links to inflation. So you've got to rely on monetary policy moving in line with inflation. And if you think that that's going to happen, which is pretty much what does happen, then I think actually your variable rate bonds are a better protection against inflation without the duration, without the capital volatility that you're getting from inflation-linked bonds.
Thank you so much, Philip. I'll move on. I'm going to take what you've just said, I think, just extend the question to Ruan. In the context, I think, of the regional question and also all the comments that Philip has made, and the fact that I think for CPI 3, 4, and 5, you could lock in the current elevated real yields would you have a different take on ILBs or completely different perspectives?
No, I fully agree with what Philip has said there. We also in our asset allocation do not see inflation linked as a separate asset class. It certainly doesn't have enough time series history to do that as well. But over the near term, next 2 to 3 months, we actually like inflation-linked bonds, given high inflation pickup over the next 2 to 3 months. And also when we look at the pricing of inflation-linked bonds relative to nominals, typically what people would use is break-even inflation, which is the difference between the nominal yield, simply speaking, the nominal yield and the inflation-linked bond. And then just look at that level relative to something else. So that should reflect forward expected inflation. And if you have a very strong view on what inflation is going to do over the next 10 years, you can make an assessment whether it's rich or cheap. It's difficult to make forward-looking assumptions or expectations and forecasts on inflation. On inflation, you see the best forecasters are getting this wrong by on average 1.5% over 1 year forward. So what we look at is, how do break-evens look at relative to spot inflation? I mean, you can use the argument that inflation is driven by inflation expectations, so it's somewhat adaptive to where you are right now. You can question that at turning points, of course, but if you look at break-even inflation relative to spot inflation, typically you would find that your break-even trades above spot inflation, but this is the first time that we're seeing break-evens trading through spot inflation, which means break-evens are low relative to where inflation is right now. So we anticipate break-evens anticipating a big fall off in inflation, which may or may not happen. So using that and that relative valuation framework, as well as forward-looking carry over the short term, we do like linkers for a quarter or so.
All right. No, thank you so much. I'm just going to close off by asking a question that has come from the audience. Essentially, I think this is from Ruit Kosia, pretty much comparing the current 1 year return of the SA money market fund versus SA bonds, and pretty much saying they're similar. And again, asking the question, why should I take duration risk? And I know we sort of already explored this particular question, but maybe we could just close off by saying, in the next 12 months, why would one, what is the possibility that South African bonds will do better than South African money market? I think just based on the audience question. So I think we can maybe have a quick closing remark from all the panelists. I'll start with you, Nolan, moving to Ruan, and finishing off with the flexible guys who are competing with cash in that space, being Jonathan as well as Philip. Thank you.
Thanks. I'm actually going to echo, I think, what Philip said a second ago. Last year was a dreadful year for bonds. I think the US press was talking about the worst year in history for certain bonds. And in the worst year in history globally, South African bonds outperformed money markets by a little bit. That's a fantastically resilient asset class. Bonds are a risk asset. And, last year was tough. Bonds actually still, didn't act as a drag in your portfolio. Looking forward, we're moving out of the worst year in history. And actually, if bonds just behave normally, you're going to have a fantastic outcome. Got to have some of this asset class in your portfolio.
Oh, thanks, Nolan. Yeah, couldn't have put it any better. Thank you. Rowan, if you can maybe add.
Yes, so Algon offers money market funds and bond funds, so we're happy with clients that enter into either one of the products. We're pretty agnostic, but I just on a forward-looking basis, yes, money market relative to bonds, bond yields don't have to sell off that much to start to underperform money market over a 1 year forward-looking horizon. So bonds are relatively expensive relative to cash, given where 1 year yields trade at the moment. In our portfolios, in our multi-asset portfolios, we actually have a bit of a barbell strategy there. We overweight SA cash and we overweight bonds, underweight SA equity. So we're participating in locking in high yields, but also getting some of that duration risk that we think could work well in a disinflationary environment.
So essentially, I think if it's a binary argument, the answer is extreme, but in the context of a full portfolio, there is room for both SA money market and SA bond to be overweight, given the earnings risk we're facing going forward.
Correct.
Awesome, thank you. I'm finishing off with Jonathan as well as Philip, in that order still.
Thanks. I was looking for an opportunity to disagree with one of the panelists, and Ruan kind of almost gave it to me. And that is the, I agree that, maybe bonds don't have that much, well, they can't set off too much in order to underperform cash. But the starting yield is so much higher than it was for a very long time, like Philip mentioned. And therefore, you can stomach some capital loss, essentially, holding bonds and still doing better than money market and cash. So I think, there is that risk premium is there. That's the first thing. The second thing is, I certainly agree on the other point that Barbara was overweight bonds, overweight cash. Is a sensible position to be in multi-asset portfolios. And maybe just the third point to the inflation argument. Again, I agree that in the next few months we're going to have what we call an attractive inflation carry. So you get a good return from just the inflation number that's coming through. But you really should be very careful of taking any interest rate risk to get that yield of that inflation carry. In other words, you want to hold only short-dated inflation-linked bonds, because you could take a lot of pain, to Philip's point, by trying to get that inflation carry over the short term, but losing capital value as a result. So that's, and just to come on from that, inflation-linked bond market in South Africa has become difficult to position in over short periods of time. It's become less liquid. It's always been less liquid than the nominal bond market, but it's becoming more of an issue, and that's one thing that we all need to keep in mind when we manage the portfolio.
All right, thank you, Jonathan, for that. Then we'll close off with Philip.
Yeah, Kurt, so you're obviously in the wrong fund. Maybe that's the starting point. So no, but I think the point is, first and foremost, is that same with inflation linkers and fixed rate bonds. You might say that bonds on average have done 5% over the last year, but longer dated bonds have done badly, and shorter dated bonds have actually done quite well. So your shorter dated bonds are over 8%, your longer dated have done poorly, similar with inflation linked bonds. But if you buy bonds historically, if you've gone and looked at the all bond index, and again, there's, the whole reason we run multi-asset income type funds is because we believe that the all bond index is not efficient. Otherwise, we just hold the all bond index. So there are opportunities all along the curve that some you want to hold, some you don't want to hold. But if you bought the all bond index historically at the yields currently where it is, your return on average has been somewhere between 14 to 18% per year for the next 2 years. Okay, so just start it there, because guess how bonds work? It's your interest rate plus or minus capital move. So if your starting yield is 11 to 12, let's say 12%, well, your starting return is 12, because that's cash flow, plus or minus capital movement. So just, I think bear that in mind, as bonds is it's an asset class that's far easier to predict the forward returns. Importantly, from this point out, it would be very hard for bonds over a multi-year period to underperform a cash type yield. There might be shorter term sell-offs, and that's the volatility. And that's why we manage that kind of risk across particularly the flexible duration type funds that we hold, and that all of us manage. But even in our bond fund that we manage as well, we've tended to quite comfortably outperform the all bond index, because it's not a great index. So I think bonds in general are the outlook is quite positive. I've been saying for a while, our positioning is a bit like Goldilocks, not too hot, not too cold. And I think what's nice with bond yields as high as they are is you don't have to be too aggressive to get the kind of returns you need. So with bond yields nearly 12% in the longer dated bonds, you don't have to be significantly overweight bonds to give you still a really good return, which is a very, very nice situation to be in. So I think the argument to hold bonds is an easy one. You don't have to be super aggressive, but importantly, I think it's priced better than other SA asset classes. And in the environment where SA bonds don't do that well, it's not an environment normally where equities are going to do that well. So I would far rather hold bonds in the bad environment than holding equities.
Thank you so much to all the panelists. I could have added a little bit more, but I'm way behind time and out of schedule. So I'm going to hand us back to Eugene. Thank you so much. Looking forward to our next interaction and next engagement. And hopefully all the views expressed would have paid off. Thanks a lot, and all the best with the rest of your week.
Many thanks to Vonga, Nolan, Ruan, Philip, and Jonathan. Most insightful session indeed. And I must say, I'm a bit more bullish than what I started off this morning on bonds and your flexible fixed income mandates. To our audience out there, as per usual, we will send out the recording plus the contact details for the BCI sales team. We spoke very little of the actual funds or how to access these managers, but if you want to get more information, please contact the sales team and we'll let you know exactly how and where. To our audience, a quick reminder, next week, Wednesday, 3 May, we will be looking at global equity and unpacking that a little bit more with one of the top global fund managers, T. Rowe Price, represented by Andrew Clifton, who's one of their vice presidents and from their equity division. T. Rowe Price has been going for about 85 plus years with a national footprint or international footprint, and it might be very insightful to see how they look at global equity at the moment. And then from our side, I'm looking forward to seeing all of you in Cape Town, or most of you in Cape Town, for the BCI Global Investment Conference, 8, 9, and 10 May. It would be really great to shake your hand there. If you can't attend in person, if you haven't registered online yet, then please do so now. If you're unsure about how and where and what, please make contact. We'll get the details through to you. The BCI team's made significant inroads of giving you a fantastic lineup of global and local managers. So really looking forward to those 3 days. From the BCI team, thank you so much to our panelists this morning, to Devonga, a wonderful audience, for your continued support. We remain ever so grateful and looking forward to seeing you next week, Wednesday, and after that at the Global Investment Conference. Keep well, stay safe.